Let me show you an example which happened in most of the investors' real life. Let's say you have $30,000 and you split it equally into 3 different stock counters, which is 10,000 each. 3 months time passed. Stock A performed well, gives you a 15% return, and that's $1,500 gain. You were very excited for it. On the other hand, stock B performed excellently, makes you a 25% profit, which is $2,500. You felt really good because of that. However, stock C had some negative news on it, causing the main force of stock markets clear its holdings, and the share price plunged as much as 50% within a few days' time. You got no choice but to realize the 50% loss on stock C, and that cost you $5,000. As a result, you did not make any money out of your investment, but incurred a $1,000 loss instead. Because of that, your mentality hurts and have no more confidence to invest in the stock market. Are these something that you have faced before? If the answer is yes, I want you to think about it again. Isn't that happen solely because you never set up a stop loss limit properly for stock C in the initial phase? It is a must to close your position. For this method, we must set a suitable range of loss, otherwise it can be embarrassing at times. For example, setting a 8% loss limit on volatile shares such as Tesla, and it rebounds right after hitting your stop loss price. Therefore, when we trade volatile stocks, I would suggest setting a higher range like 12 to 15% and 6 to 10% would be nice for stocks that aren't that active or volatile. The second method is setting stop loss limit based on your entire portfolio. It is a stop loss range calculated based on your total capital invested. Let's say you have a total of 100,000 for investment, and every single time you trade or invest, the maximum loss you can accept is 1,000. So, when you invest into a stock counter with a capital of $10,000 and stop loss limit is $1,000, that will be equivalent to 10% as we divide 1,000 by 10,000. The above two methods are simple and suitable for investors who are new to the stock market. Now, let's look at the third method, stop loss by following the technical exit signals on chart. The common ones are to follow moving average lines and candlestick patterns. For short-term traders, we can follow 5 days moving average line, and for mid-term traders, 21 days moving average line can be a good reference. When the share price breaks below the MA line for 3 consecutive days, it is a stop loss point to avoid incurring a larger amount of loss. The advantage of this method is its great flexibility, while the advantages are that it requires strong basics on technical analysis and great discipline for execution. The fourth way of stop loss is called entry logic destruction. For example, we have made an entry as the share price breaks up the resistance level and become a new support level. The stop loss limit to be set here will be the price level of the support. If the share price breaks below the support level, we must exit our position as our entry logic has been disrupted. Alright, so these are the 4 ways of stop loss that I would like to share to you today. They are easy to learn yet difficult to execute. It requires great discipline because when it comes to cut loss, we usually have all kinds of bad emotions within ourselves. Also, cutting loss is crucial in our trading or investing journey. Even the professional investors like Warren Buffett made mistakes in investment decisions. Therefore, do not ever neglect the importance of cut loss.